You don't need to be a genius in what I do. That's the good thing about it.
Warren Buffett is one of the most successful investors of all time. And in this video, we're going to take a look at his story and the principles that helped him achieve financial success. We'll also share some tips on how to use these same principles to improve your financial situation. So make sure to take advantage of the valuable insights and strategies that Warren Buffett offers. Keep watching until the end to learn how to improve your financial situation. Introduction to Warren Buffett. Warren Buffett, also known as the Oracle of Omaha, is one of the most successful investors of all time. He is currently worth over $100 billion, making him one of the wealthiest individuals in the world. Yet, despite his immense wealth, Buffett is known for his down-to-earth and frugal lifestyle. Buffett started investing when he was just 11 years old, buying his first stock. He would go on to study business and economics at the University of Nebraska and the University of Pennsylvania, and eventually began working as a stockbroker and investment analyst. Then, in 1962, he founded Berkshire Hathaway, a holding company that would become his primary investment vehicle. Buffett has been known for his steady and consistent approach to investing throughout his career. Rather than chasing after the latest hot stock or trend, he focuses on identifying undervalued companies with strong fundamentals and a history of profitability. He is also a proponent of the principle of margin of safety, which is about minimizing risk by only investing in companies trading at a significant discount to their intrinsic value. In addition to his investment acumen, Buffett is known for his wisdom and insight on various subjects. He is a frequent commentator on the economy and markets, and is often sought out for his thoughts on financial and business matters. In addition, his annual letter to Berkshire Hathaway shareholders is widely read and respected for its candid and thoughtful analysis of the company's state and economy. Warren Buffett's investment philosophy. An essential aspect of Warren Buffett's investment strategy is his approach to diversification. Unlike many other investors who prefer to spread their money across many different stocks, Buffett prefers to focus on a few large investments. This is because he believes that he can better understand their business and make more informed investment decisions by putting a significant amount of money into a small number of companies. This approach, alongside his emphasis on finding undervalued companies trading at a significant discount to their intrinsic value, which we discussed earlier, helps him to minimize risk and make sound investment decisions. Buffett prioritizes the management teams of the firms he is interested in investing in addition to identifying cheap companies with solid fundamentals. He believes that a solid and competent management team is crucial for long-term success, and that investing in companies with leaders with a track record of creating value for shareholders is important. Finally, Buffett's investment strategy is also heavily influenced by his overall macroeconomic outlook. He is known to be cautious during times of high uncertainty and will often avoid investing in markets that he believes are overvalued or experiencing a bubble. One example of Warren Buffett's investment philosophy is his investment in Coca-Cola. In 1988, Buffett began buying company shares, eventually becoming one of its largest shareholders. At the time, Coca-Cola was trading at a discount to its intrinsic value, and the company had a strong brand and a history of profitability. Buffett was also impressed with the management of the company, led by Roberto Goizueta, who had a strong track record of creating value for shareholders. Additionally, Coca-Cola had a dominant market position in the global soft drinks industry and had a strong distribution network. Buffett's investment in Coca-Cola exemplifies his approach to finding undervalued companies with strong fundamentals and a history of profitability. His patient and long-term perspective paid off as he held on to the shares of Coca-Cola over the years, and they contributed to his wealth significantly. It's now one of Berkshire Hathaway's most significant and profitable investments. This approach showcases why he's considered one of the most successful investors of all time. Warren Buffett's secrets to success. Warren Buffett's key to success is his ability to remain patient and think long-term. He has a reputation for ignoring short-term market fluctuations and sticking to his investment strategy, even when the market dips. As a result, he doesn't make decisions based on daily or even yearly market performance. Instead, he looks at the company's performance over a much more extended period, often decades. Buffett is known for conducting extensive research on the companies he's interested in investing in and for having a deep understanding of the industries in which they operate. He is also an expert at analyzing financial statements and can quickly spot signs of a company's potential for growth. Buffett also can remarkably keep his emotions in check regarding investing. He does not let greed or fear drive his investment decisions. Instead, He sticks to his well-thought-out and tested investment strategies, even during market turmoil. Furthermore, Buffett has a strong aversion to debt. He is known for not levering up to make investments. This approach helps him to minimize risk, allowing him to stick to his investment strategy even during market downturns and take advantage of opportunities that others may pass over. The capacity of Warren Buffett to surround himself with talented people is a crucial component of his success. Throughout his career, he has been known for finding and attracting top talent to work with him, both at Berkshire Hathaway and at the companies he invests in. For example, he has a team of investment managers and analysts who work with him to identify and evaluate potential investments. This has allowed him to expand his investment horizons and find new growth opportunities. Similarly, he has a history of finding and investing in companies with strong and experienced management team, which has resulted in many successful investments over the years.
I've got people you wouldn't believe that support me.
Additionally, Buffett has also been known to bring in experts in specific fields to help him evaluate and invest in companies that operate in those fields. For example, he has brought in insurance, transportation, and energy experts to help him assess investment opportunities in those industries. Having a solid team around him has not only allowed him to make sound investment decisions, but has also helped him to scale his business and increase his wealth. It's a key factor contributing to his long-term investor success. 7 tips from Warren Buffett for building wealth. Tip 1. Start investing early. One of the critical principles of Warren Buffett's investment strategy is to start investing as early as possible. By starting early, you give your money more time to grow and compound, which can lead to significant returns over the long term. For example, if you start investing $100 per month at 25 and earn an average annual return of 8%, by the time you reach 65, your investment would be worth approximately $940,000. However, if you wait until age 35 to start investing, even if you invest twice as much per month, your investment would only be worth approximately $620,000 by age 65. This illustrates the power of compound interest and the importance of starting early. Additionally, starting early also allows you to take on more risk, as you have a longer time horizon to weather any market fluctuations, which can lead to higher returns. Moreover, it also allows you to learn the ins and outs of investing, giving you the knowledge to make better decisions as you grow older. Tip 2. Invest in what you understand. One of Warren Buffett's most famous quotes is, "Invest in what you know." He believes investing in industries and companies you know about and can understand is important, as it helps you make more informed investment decisions. By investing in what you know, you will have an edge over other investors who are less familiar with the industry or company. You will be able to better evaluate the company's financials, as well as its competitive position, and you will be able to identify opportunities or warning signs that others may miss. Furthermore, you will be able to follow the company more closely and therefore have a better understanding of how the company's future is shaping. By focusing on industries and companies you understand, you'll be more likely to be able to stick with your investments through market fluctuations rather than making impulsive decisions based on short-term market fluctuations. Tip 3. Look for undervalued companies. As we mentioned, one of Warren Buffett's most important investment strategies is to look for undervalued companies trading at a discount to their intrinsic value. By investing in undervalued companies, he aims to minimize risk and increase potential returns. When looking for undervalued companies, Buffett considers various factors such as financials, management team, competitive position, and growth prospects. He then compares these factors to the company's stock price to determine if it is trading at a discount to its intrinsic value. One way to look for undervalued companies is to use value metrics such as the price-to-earnings ratio, the price-to-book ratio, and the price-to-cash flow ratio. These ratios compare a company's stock price to its earnings, book value, and cash flow, indicating whether the stock is undervalued or overvalued. Another way is to use comparative or relative valuation methods, such as the dividend discount model or earnings power value. Another important thing to look for is the history of profitability, as it indicates a company's ability to generate earnings and therefore more likely to generate cash flow and pay dividends. It's important to note that finding undervalued companies can be challenging and requires a lot of research, analysis, and time. Therefore, it's crucial to be patient and not make impulsive decisions based on short-term market fluctuations. Tip 4. Invest for the long term. Warren Buffett believes in the power of compounding returns over time, and he has stuck to his strategy through market fluctuations, which has paid off handsomely. By investing in companies with strong fundamentals and a stable history of profitability, you can benefit from compounding returns over the long term. Additionally, you can benefit from compound interest and potentially higher returns due to market fluctuations by investing for the long term. By buying and holding stocks in undervalued companies that have strong fundamentals and a stable history of profitability through market cycles, you can profit by buying low and selling high. Tip 5. Diversify your investments. According to Warren Buffett, diversification is paramount when investing. Spreading your money across various assets and industries can help reduce risk. He advises investors to not put all their eggs in one basket, as this could result in huge losses if one company or industry performs poorly. Instead, he suggests investing in various companies across different sectors to reduce risk. Furthermore, diversifying your investments can help you maximize returns by taking advantage of the potential for higher returns from specific sectors or markets. Investing in a range of assets and spreading your money across different investments with varying levels of risk can achieve higher returns over the long term. Tip 6. Read, learn, and stay informed. Warren Buffett believes in the importance of staying informed and up to date on current market trends. He is an avid reader and recommends that investors spend time researching potential investments before taking action. In addition, staying informed on market developments can help you make better informed decisions when investing. It's important to remember that investing carries risk, but with the proper knowledge and strategies, you can reduce your risk exposure and maximize potential returns. By following Warren Buffett's advice, you can also succeed in investing. Taking the time to research, analyze, and assess investments thoroughly before making any decisions is essential for any investor. Tip 7. Have realistic expectations. It is important to set realistic expectations when investing. Many investors expect to make huge returns overnight and get rich quickly, but this is rarely the case. Warren Buffett emphasizes the importance of having a long-term approach and understanding that investing takes time. Investing in stocks requires patience, discipline, and consistency. Overly risky investments or impulsive decisions can quickly lead to losses, so it is essential to have realistic expectations when investing. Warren Buffett has achieved extraordinary success by adhering to a simple yet disciplined approach and following his own advice. Understanding and applying his strategies to your investments can also create wealth over time. He believes that anyone can become an investor, regardless of their current financial situation, with the proper knowledge and strategy. Watch our next video if you want to learn even more important tips from Warren Buffett and take your financial knowledge to the next level. Take advantage of the opportunity to learn from one of the greatest investors of all time and take control of your financial future. Be sure to subscribe to our channel and turn on notifications so you never miss out on our latest content.